Thanks. Well, welcome. Thank you, everyone, for coming to my talk tonight. I'd like to talk to you about a form of artificial intelligence that we have found particularly useful. It is very different from what you read in the newspaper or hear from social media about the things that Google or Facebook or OpenAI are doing. But this is the kind of AI that we find to be actually more practical for solving many commercial problems, including and particularly in asset management. It is what we call AI that corrects human decisions. So we call that corrective AI or CAI or CAI, whatever you acronym that you can come up with. It is what we believe is that AI is more effective in correcting human decisions than in making them from scratch. You hear a lot about artificial general intelligence, where AI is driving the car for you, AI is composing articles for you, AI is making graphics for you, and so forth, or generating, composing music. Well, if you just look at one of those examples, self-driving cars, you don't see that they are everywhere yet. Even for Tesla, they ask you to put your hands on the steering wheel. It is not quite we are not quite there yet. On the other hand, assisted driving technology like lane change detection or collision avoidance system, they are ubiquitous. You can't find a new car these days without those technologies. So this is a very simple illustration where today, at least, AI is much more effective in correcting human decisions, such as that of a driver, than for making them totally from scratch. It's much harder to do that. Now, let's focus our attention because I have been a hedge fund manager for the last decade, and I started my career. I started my career as a machine learning researcher at IBM TJ Watson Lab, and then I went into the financial industry in applying AI to finance. So my domain expertise is definitely squarely in finance. Now, you would have thought that, with my machine learning background and my knowledge of finance, some of you may have read the books that I've written. It would be a piece of cake to make AI work in finance. That couldn't be farther from the truth. But that is not just a problem that I personally experience. It's not just because of a limitation of my intelligence. I would characterize the period from year 2000 to 2018 as the financial AI winter, which is a parallel to the AI winter in the larger world. If you read about the history of AI, you know that there are long periods where it was going nowhere. Before, for example, I believe around 2015, where University of Toronto professor Jeff Hinton published a paper on how to improve the neural network. Well, neural network wasn't going anywhere for the longest time. It was called the AI winter. So similarly, from year 2000 to 2018, we have the financial AI winter, where most AI applications in finance and in particular in trading and asset management fail. Why has that been so difficult for AI to succeed in trading? One reason is because the signal to noise ratio in the financial market is very low. Well, if it were high, if it were so easy to find obvious trading signal, obvious arbitrage opportunities, obvious profitable trading opportunities, many millions of traders would have found it. So whatever the machine learning algorithm found were only opportunities that existed in the past. But by and large, those opportunities would have been arbitraged away. So we have a severe problem of what we call overfitting or data snooping bias. Much more serious than what you would find in, let's say, image recognition or speech recognition. Secondly, there's a notion called reflexivity in finance, which is that it's a term that is coined by the famous investor George Soros. What he meant is that by your action in trading, by your trading decisions, you have changed the market conditions. That is different, again, very different from image recognition. If you were able to differentiate between cat versus dog in an image, the cat won't change its appearance to fool your system. On the other hand, if your AI system detected a trading opportunity and you act on it, the other counterparty of that trade will change their strategy. A example is that a lot of times there's a phenomenon that there is a trend following behavior towards the end of a trading day. If the market went up a lot towards the end of the day, typically it will go up further in the last hour or half an hour of the day. But that phenomenon has become less prominent in recent years because a lot of people have been trading on it, and the counterparty, such as those ETF that need to rebalance, the lever ETF that need to rebalance towards the end of the day, they take measures to overcome that problem because they are evidently losing money because of this arbitrage trading activity. So as you can see, the act of taking advantage of certain signals will directly cause the signal to go away. And that problem does not exist in most other applications in AI. And then finally, there is the issue of regime change. Even if there's, your model worked perfectly and it has not suffered what is called alpha decay because of reflexivity, the market environment can still change. The probability distribution of returns of prices are not stationary. That is, again, violates one of the fundamental assumptions of machine learning, which is that the environment had to be stationary, that what you learn in the past has to be applicable in the future. In finance, oftentimes there's structural change in the marketplace, in the economy, which renders whatever signals that you have learned, whatever patterns that you have learned using the machine to be obsolete, and they are no longer going. Mainly, I would say by Professor Marcos Lopez de Prado of Cornell, who is also the head of AI at Abu Dhabi Investment Fund, that AI and machine learning can be much more successful in risk management and optimization. That's what we call corrective AI. Because by what this risk management means? Risk management means that the AI system, instead of predicting which way the market is going, is used to predict whether the investment strategy that you use is going to lose money or not. The machine learning system is learning from your own investment strategy track record. It is not learning from the public market. Because it's not learning from the public market, it is not subject to reflexivity, because no one is going to benefit from that running the same system. Even if you give this system to other people to run, and they can very accurately predict whether your strategy is going to be profitable or not, they cannot arbitrage against it because they don't know your base strategy. And so reflexivity is defeated. There's no reflexivity. Regime change is not a problem either, because by and large, those base trading strategy that you are running are going to work well in certain regime and not work well in some other regime. And in fact, the machine learning system is learning from the market what regime is favorable from the strategy. So the fact that the regime changes is okay, because that's what the machine learning system is learning, is to learn to find out what regime we are in and whether it's favorable to your trading strategy. And finally, when we are talking about overfitting, well, that's overfitting mainly because the signal is weak, as you said, as I said, the fact that the signal to noise ratio is low. But when you have a trading strategy, the signal to noise ratio is actually increased, because the market has very low signal to noise ratio, because if you can predict consistently what the market is going to go up or down, that opportunity will go away because of arbitrage. But when you are trying to learn, but your own strategy clearly should have a better Sharpe ratio than the market itself. It has a lower level of noise than what exists in the market. If not, your trading strategy won't be successful. We are depending on the fact that your own trading strategy has been a noise filter to remove some of the noise from the market. And therefore, when the machine learning system is applied to learning from your own trading signal, the signal to noise ratio is much increased. So all the three facts, the three reasons why machine learning had not been successful in trading are overcome if you're using machine learning for risk management. To be very specific, what risk management means is that we applied machine learning to learn from the returns track record of a trading strategy, together with big data that capture the market environment to predict a probability of profit for the next trade. That's what we meant by risk management. Now, we also have a second application that we have found that is very successful for asset management, and that is optimization. Optimization, of course, is a notion that is very important in any industrial commercial process, not just finance. But in finance, it typically means one of two things. If you have a trading strategy, optimization typically means how to optimize the trading parameters. For example, if you have a trading strategy that said buy low, sell high, one parameter would be how low do you have to go to buy, and another parameter is how high do you have to go to sell. In other words, what's the entry threshold and what's the exit threshold? Those are already two parameters. Typical trading strategy has at least 3 or 4 or even more parameters. What are the best parameters to use? Well, in the old days, the way to find out these parameters is to just try all combination and find out what worked best over the last period. With machine learning, what we can do is to find out in each particular market condition, under each market regime, what are the best parameters to use, instead of just blindly saying, this is the set of parameters that work well in the last 10 years. Now, similarly, conditional portfolio optimization has the same meaning. Now, portfolio optimization typically means what capital you allocate to each stock in the portfolio, or if you have a portfolio of futures, or if you have a portfolio of currencies or cryptocurrencies, it's the same question. How much do you allocate to each component? That component can even be a portfolio of trading strategies, right? If you're running 10 trading strategies, how much leverage, how much buying power should you allocate to each? That's a portfolio optimization problem. And again, the traditional method of optimizing these allocation decisions is based on what worked best in the last 10 years. But of course, what worked best in the last 10 years may not work best in the current environment. We need to take into account the current environment, the external environment, in order to obtain a better optimization. And that is not just a theory. We have shown through many use cases that this method actually works better than conventional optimization method. So I have kind of very high level view of what what we find to work in finance. So let me go through some of these ideas in more detail. So corrective AI is a system to compute the probability of profit of a base trading strategy. That base strategy could be a discretionary strategy or could be an algorithmic strategy. And the objective of the corrective AI is to predict the strategy, not the market returns, with many, many big data features that survey the entire market, features such as the volatility of the market, whether interest rate is going up, whether oil price is going up, whether GDP growth is positive or negative, and so on and so forth. Because your strategy's return data is private, and because we only learn from your private strategy return, the signal to noise ratio is much higher. That's what I said earlier. And if you have obtained this probability of profit, you can use it to decide, obviously, if the probability of profit is low, you might decide not to enter into a trade. If the probability of profit is high, you might decide to increase your positions, your trading size. This differs from traditional risk management in the sense that, again, risk management traditionally looks backward. It doesn't care about the market environment today, whereas corrective AI definitely takes into account the current environment and it adapts it continuously to the current environment. In terms of regimes, we have we rely a lot about regime detection to accomplish this corrective AI. In the usual understanding of regime, there's bull market, bear market, there's choppy market, there's flat market, there's risk on and risk off, inflationary and deflationary. These kind of regime affect every portfolio. They are easy to identify, but it is hard to predict. On the other hand, there are regimes that are hidden. For example, there are regimes that are based on because of Robinhood traders are buying call options on small cap stocks. They may be because a hedge fund called Archegos or a family office called Archegos are liquidating the portfolio. And a lot of these regimes affect only certain style of investing. It is not a regime that affects the broad market. Interestingly, these hidden regimes are much harder to identify because you can hardly see why is it only affecting one strategy but not the other one. But they are actually easier to predict because they have a specific root cause that can be identified if you look hard enough, if you use machine learning to identify them. And that is exactly what we did. We are able to predict or identify these hidden regimes. And by identifying, we don't mean that explicitly telling you, oh, this is regime 1 or regime 2. Everything is sort of a implied. It is a collection of the values of the hidden features that identify the regime. But by identifying this regime, we are able to tell you what's the probability of profit of your portfolio. And also, we are able to, based on that regime, properly optimize your portfolio. So that's what we call conditional portfolio optimization. So just to I think that many people would say, what are the traditional method of optimization, of portfolio optimization? There are 3 kinds, and they are risk parity portfolio, there's minimum variance portfolio, and there's a market risk portfolio. I won't go into all of them because they are covered in every finance and investment textbook. It is related to where you are on the efficient frontier. Again, that is a concept that is covered in every finance textbook, so I don't want to go into the details of it. But what we find is that none of all these points on the efficient frontier only refer to the past. nobody guaranteed that what a portfolio that was on the efficient frontier in the past is actually efficient going forward. And that is what conditional portfolio optimization is trying to accomplish. It's trying to find the optimal portfolio in the future using big data, not what it was optimal in the past and not what was optimal over a long period of time. So I think that, I would leave, I typically give a talk that is half an hour and I leave some time for questions. So I will, we have about 6 minutes, so I'll quickly wrap up the me talking part of the seminar and let you ask some questions. Here, I would just go through quickly some of the success of this technique. We applied the conditional portfolio optimization method to S&P 500 portfolio. It created it increased the Sharpe ratio by 3 times in the outer sample test. We applied it to a crypto portfolio. It increased the Sharpe ratio 3.8 times over the traditional optimization method. We apply it to a ETF that is being actively traded. We increase it the Sharpe ratio over equal weights portfolio by 50% out of sample, and it improve over the maximum the market weights portfolio by even larger margin. Okay, so and we apply it to a portfolio of Forex strategy that a client of ours was trading, and again it improved the Sharpe ratio by over their current method by over 100%. So, and we applied to a client stock portfolio, which is a portfolio composed of many tech stocks, and we find that it improved it over the client's existing method, which is again an equal weight method, by over 50%. So we find that obviously you have to add other constraints to portfolio. Oftentimes the client do not wish to short stocks. Sometimes you have to make sure that the certain sector weight are not greater than a certain limit. But these can all be taken care of. Even after taking into account many of the constraints, the portfolio optimization method based on machine learning is still superior to what can be accomplished in traditional method. So I wouldn't go. I think that I don't want to take up too much time to just give you the details of the two methods. If you are interested in what I talk about, please feel free to come to our website, predictnow.ai, to look for more of the in-depth articles that we have written. And also, I invite you to check out the books that I've written, particularly Quantitative Trading Second Edition. And I would have a lot of information about the more basic aspects of trading, and not so much, and touch on some of the machine learning aspect, not all of it, not much as in depth as what we present on the website. So, I will skip the introduction by my colleague. So I think I would open the floor for any questions. Before we end tonight's webinar.
Thank you, Dr. Chen.
Thank you very much.
Yeah, I probably need machine learning to diagnose why my computer reboot. So I hope that's why there's a theory, right? When you most need a service, it's going to crash. So,
of course.
Yeah, it's interesting. Yeah, but thank you so much. Was not able to reboot the server, so I just start my cell phone. So
sure.
So yeah. I think one thing I do want to ask first, and also let my coaches and students to ask, when you talk about this, collective, AI, right?
Mm-hmm.
I was thinking that when you think about this very interesting system, that you're not using the traditional way of, using AI purely to predict the market, or
that's right,
or join the market as an individual, right, or agent, smart agent. But just like I have a kid, right? I'm not asking AI for what's the best school that my kid can go to, and they will give me recommendation like, oh, my daughter, you should go to like Stanford, right? And then my son may go to Caltech. But that's not the strategy. It's that you're asking me as a father to bring a strategy how to, based on my observation of my kids, right, my daughter and my son, and then your AI is going to give me correction or recommendation based on my strategy, so that I can provide a better chance of letting them into the school, right? College. Is that good? Good explanation of what you're trying to do?
Yeah, we don't make the decision for you. You make the decision, but we will tell you a probability that your decision is correct or wrong.
Wow, that's very interesting. The first time I heard it, it's totally, and you bring to me a new idea about how we can cooperate with AI and how we can work together. That's wonderful. Yeah.
Yesterday I just spoke with a medical technology company. So a lot of doctors, for example, are very wary, not just doctors, but patients are very wary of having a robo doctor, right? You sit in front of a robot and the robot said, hey, I think you have cancer. That's something that most people won't accept. You say, are you sure? Is a robot going to tell me I have a cancer or not? But instead, what we propose is that, no, the doctor will consult our AI system. If the doctor say, this patient has cancer, and then it will consult our AI system. Our AI system will give them a probability that this diagnosis is correct or wrong. So we are not the one to make the decision, the diagnosis that the patient has cancer. It's the doctor would say that, but we will give them a kind of assisted AI or corrective AI to tell the doctor this is this diagnosis has a high accuracy, or it has kind of borderline. So because a lot of times when all you hear from the doctor is that, okay, you have cancer, but you don't know how certain this doctor is, right? The doctor may be 100% certain, this is no possibility this is wrong, and sometimes they may be just borderline, maybe okay, maybe you have cancer, maybe 51%. So when oftentimes the doctor will give a probability, okay, I think you have a 51 chance of cancer. But where does this probability come from? Usually it's a subjective probability. The doctor just think that it's 51%. Well, why not 55%? Why not 59%? There's no quantitative method that the doctor uses to give you this probability that you have cancer. That's unlike our system. Our system will actually generate a probability based on rigorous past historical data to tell you, this doctor says you have cancer, and he is probably 55% right. That is what is going to make AI much more practical, even in the medical diagnostic field, not just in investment management.
Yeah, that's great. Yeah. So I just follow on my question, and then I let other coaches and students and parents to ask. So is that the idea you get this corrective AI? Is it because the financial market is so much time and money sensitive? And then you mentioned that the facility, right? The Soros, right? You mentioned that whenever a big whale, jump into the pool, right? You're going to bring a lot of, impact to the pool, right? It's going to have a big impact to the market. Is that because of the market condition that you are predicting in the financial market is so sensitive to any activity that a newcomer or even AI, jump to the market, or it's more general to every industry? Can you give us some hints?
Well, I mean, the financial market has those specific characteristics which make it AI particularly difficult to make correct predictions. But corrective AI is, of course, a very general concept. It can be applied, like I said, to medical diagnostics, to even right now we are working with an oil and gas company to predict whether oil well is productive. So every time there is an existing system that makes decisions, whether it is an investment manager or whether it is a oil well explorer or oil explorer, or whether it's a doctor, corrective AI is going to be able to help quantifying that decision. And in finance, but now in many other fields, you might say that, well, why don't you can use AI to take over that human decision, and maybe they would be successful in many of the fields, such as medical diagnostic, although it won't be acceptable, right? Even if it is successful, a lot of human factor makes it impractical, like in medical diagnostic. But in finance, you can't even do it because a lot of times the AI system are unable to make a successful decision on its own. It's more difficult in finance to actually make it work on its own. So it is kind of a necessity in finance to use corrective AI, not a luxury. Whereas in maybe medical diagnostic, you can say it is because of human resistance that make AI not practical, and not an intrinsic deficiency of AI that make it so.
Yeah, very good. Thank you so much, Dr. Chen. Yeah, any other question from the student or coach? You're welcome to ask, or our parents. So I know this is a new topic for you, right? You know, your students are learning AI and machine learning in our class, and some of them are also actually, you know, getting running the race and get award, right? So being top 10%, which is wonderful. Yeah, but you know, AI is very broadly used in many industries, like Dr. Chen was saying that in finance, like portfolio management. That may be some of your kids' interests. Yeah, just feel free to ask questions. Yeah.
Yeah, Dr. Chen, it's a very interesting talk. Since some of us here are students, some of it because we operate this LeadingAI, and your background is actually very interesting. I think you got your PhD in physics. I think you pivot to machine learning and to finance. Maybe you can also share with us how you got into machine learning and finance. I think that would be, I think, very interesting for many of us here.
Yeah, it is indeed, interesting journey that I had. So I was an undergraduate in physics at the University of Toronto, and I was one of the top students, and I was one of the top students in Canada. From the results of national exams in Canada. And I thought, well, I definitely want to be a physics professor. So I then applied for some graduate school. I was accepted into MIT as well as in Cornell's physics program. But I chose Cornell because I have friends there, so I wanted to, hang out with my friends. So I went there. And then in the first few weeks, I immediately find that I'm not cut out with physics. And the reason is that all my classmates are from the top of their countries. For example, some of my classmates ranked number 5 in China. And then another say that he's the best physics student from Germany. And once you compare with them, you find that the competition is just too keen in physics. And I'm not that smart to compete with them, because the number of jobs in physics are very small. So you really need to be the top in your class to even consider a potential job offer. So you could just forget it if you're not the top in the class. So right from the beginning, I realized that physics is not what I'm going to be, in my career. So what then? Fortunately, I developed an interest in pattern recognition. And pattern recognition is essentially what machine learning does. So I read a lot of papers, I attend lectures, but I never took a formal course in machine learning. I just attend as an audit some courses. And when I did finish my PhD in physics, with a lot of work, I, got my PhD. But when come time to find a job, I definitely don't want to get a job in physics. I want to get a job in machine learning, which is my interest. My interest has shifted, and also because of the practical fact that I'm not as good as the other physics student in physics. So how do I go to find a job in machine learning? Because I've never even taken a course in machine learning, not to mention written a paper in machine learning. So I applied to literally 100 firms, from just from AT&T Bell Labs to IBM to Xerox PARC at that time, literally every tech firm that you have ever heard of, and some that you haven't, who has a machine learning research group, right? And of course, 99% of them rejected me, say, who are you? You never even taken a course in machine learning. Why should I hire you? With the exception of IBM, because IBM's machine learning group is a very unusual group. It is run by a group of people who are originally physicists. Most of them are physicists, and some of them are mathematicians. So, and also because one of the guy from physics from Cornell was hired a year ago, and he was very successful in that group. So based on the track record of him, I was given a chance to interview. So I was interviewed for 72 hours. And finally was offered a job after 6 months. This 72 hours was not, all done in one shot. It was spread over 6 months. So finally, after 6 months, I got this job. And that's how I got into this field, which is very exciting in machine learning. And after me, and I did very well in the group. So after me, they keep hiring physics PhD from Cornell to get them into machine learning, so, which is, an interesting side effect of me getting into that group. So, but at the time, when I got into IBM, I also observed a phenomenon. Many of my senior colleagues have started leaving that group to a hedge fund that was quite unknown at that time. No one heard of that hedge fund. It's a hedge fund called Renaissance Technologies. So I find that, a lot of the very senior people leaving, and they all tell us that they got double or triple the salary. I said, at that time, I've never heard of the notion of hedge fund. But after a while, I also decided, well, maybe if they are so successful, maybe I should also go try my luck in finance, because machine learning seems very useful in finance. Well, otherwise, why would they get triple the salary? Well, the reality is much more complicated, as I've mentioned in my talk. But Renaissance Technology turned out to be one of the most successful hedge funds of all times. They have generated, before fees, 75% return for every year for the last 25 years. And some of my colleagues have already become billionaires. So I should have followed them to that hedge fund, but I didn't. Too bad. Nevertheless, it is, it's quite by coincidence that the people that I work with have become, very famous and very rich, and books have been written about them. So, it was an exciting time, but I did not regret going into machine learning and not going to Randtech, because then I can actually apply machine learning, like in this new company, to fields that are outside of finance, and which is actually perhaps can be much more impactful to society than just applying machine learning to finance proper.
Very interesting. I think your history or your career path, I think it's very interesting, I think, to many of us, right? Especially students here, because I think what you are saying is that you basically, I would say you learn. You are not confined to a particular career, right? You basically pursue your dream, and then you go after it. So I think it's very interesting. And actually, my son is ophthalmology resident. And he is actually using machine learning to help him to diagnose eye problems. So definitely that's an area which has a lot of potential.
Great. Yes, I agree.
Okay. How about other folks? Any students and parents, and any questions about Dr. Chen?
Hi, my name is Chen Liang. I'm from San Antonio. The talk is very inspiring and very interesting. I am the beginner, so the AI. I just start to join the group and to learn about the AI. From your talk, and it seems to me that the 2000 to 2018 is the winters of the AI in the financial fields as well, right? From the Dennis present quite a while, a couple of weeks ago, and it talked about that the winters like that. So my understanding, because I'm doing the medical, I'm doing the genomic, big data analysis as well. So that's why I'm drawn to this group. I would like to learn to use the AI. So from my understanding, could it be like something, the big data or the genomic data, and we have bottlenecks as well, because in all the algorithms that we develop, we still can only find a little bit, subpopulation or some certain group of the people. So it seems like a little bit of supervised thing to tear down the big data, and then we get the more meaningful interpretation or something like that. Would be the winter time that people, when they expose all the data together, the AI cannot or sharp enough to get the meaningful data. And now that if you focus on the risk prediction or risk management, you kind of, get a small population of the big data, and then you can get a more focus and then get a more meaningful data. Because I would like to, hear from you. What is that correct, or I'm far off from the reality?
Well, certainly, data is very critical in deciding whether an AI predictive system is going to be accurate or not. So more data, the better, of course. And so yes, the insufficiency or unavailability of data is definitely going to be a limiting factor in any sort of success of an AI system. However, in the case of the AI winter, both in finance and outside finance, the reason was not the lack of data. Actually, there was plenty of data. The reason was algorithmic. So in the case of the general AI, the winter in neural network, the reason was that people were not building the correct architecture of neural network. Those neural networks were overfitting. So what Jeff Hinton did, the major breakthrough in neural network was this technique called dropout. And what dropout does is to remove certain nodes by random from a neural network. That solves the overfitting problem, and that makes neural network much more useful, much more practical. And that is the created the dawn of deep learning. So deep learning was born mainly because of that technique of avoiding overfitting. It has nothing to do with the in terms of data. It's an algorithmic breakthrough. And similarly in finance, it's not that suddenly in 2018 there was much more data. Yes, there were much more data, but I think the main, but that just the abundance of data itself does not is not the cause of the end of the financial AI winter. The cause is again what I would call corrective AI, the idea that you should not use AI to predict asset returns directly. You should use it to predict the strategy's return, and that is again a you might call it an algorithmic breakthrough. So now for individual problem, given that we have this kind of algorithmic understanding, with deep learning, with a dropout technique, and with corrective AI, and with conditional portfolio optimization, and so forth. Now that we have the algorithm, then of course for specific projects, you would then want to have as much data as possible to apply this technique to. Because even though the algorithms have been improved, without data they still can't do any magic. So I would put it that way.
Okay, great. Thank you.
You're welcome.
Okay. Hey, thanks, Doctor. I used to work for Chess, JP Morgan Chess. I know a bunch of people. In fact, when I talk about people I know, most of them are programmers. Most of the people I know, they are risky people. we have lunch together many times. Asking what is risk. Nobody ever told me clearly what it is. Actually, why there are so many people do risk. Actually, if there are people hacking the bank, they need programmers. Why do they need the risk? So, thank you. You explained that quite well today about the definition of risk. And what I would like to know, like you have done a lot of experience, many work in the AI area, and I try to understand, like, how do you find the practical applications using the AI technologies? Do you have some insights there?
Practical applications in finance or outside?
Any area, any place.
Within finance, okay. Well, I mean, we have, like I mentioned in the talk, there are two main applications. One is to compute the probability of profit of every trading strategy, right? So based on that, you can decide whether to make a trade or not, or if you make a trade, how much leverage to apply. that is of critical importance to the risk-adjusted return of a strategy. We demonstrate that it can improve a risk-adjusted return by a factor of 50% or more. The other one is the practical application is portfolio optimization. How much capital to allocate to each component of a portfolio. That is a decision that faces investment managers, every day. And again, that if you have, even if you pick the stocks correctly, let's say you have a portfolio of 10 stocks, and generally speaking, those 10 stocks are good stocks. But if you allocate capital inefficiently or incorrectly across them, you have not realized the full potential of your stock selection. So portfolio optimization is a critical layer after you have made your initial decision of what stocks to hold in that portfolio.
Thanks.
Thank you, Dr. Chen. Yeah. And any other questions? I have one. Oh, go ahead.
I have a question. So for AI technology, will that be in someday available for people like individual like us? Because like if like a financial institution, they use AI technology, but the people like me, we don't have those knowledge or accessibility. Does that mean like it will be harder for us to make money in the future?
Well, we are looking to partner with brokerages and other trading platforms to offer this technology to retail investors. So we do not envision, offering this technology directly because it requires a lot of data to make it work. So, but we do intend to partner with other financial institutions to offer that to their customers. So at some point, hopefully you would see corrective AI being quite widely adopted if these financial institutions become our partners in this offering.
Okay, thank you.
You're welcome.
Great. Can I ask a question here? So right now, I think when we look at the stock market, right, we talk about that a lot of this buy, sell, it's not by human, it's by robot, by the algorithm, right? Are these approach, sell or this kind of thing by robot? Is that also based on AI or machine learning?
So that's a very good question. Traditionally, when you say AI, it actually means one of two things. One is expert system. So in the old days, when you build a program to play chess, for example, that's an example of an expert system. You program many, many rules of, okay, if your opponent move this move, what are the potential moves you should try? What is the best move you can do? And if the opponent then react by making some other chess move, how should you respond? Those are hard-coded into the software. They are hard-coded by experts. Once they're hard-coded, they doesn't change. The rules are fixed once and for all. They are very complicated to program and impossible to change, but very difficult to change. It doesn't evolve. Those are called expert systems. And most of the trading programs that you see, like robot trading programs, they are a form of expert system because those trading rules are, again, once fixed, doesn't change. Machine learning, however, is a different kind of AI. It's also part of AI, but it is a very different kind of AI because machine learning, the rules are not hard-coded by human experts. The machine learning system is almost like a learning organism. It learns by itself from the environment. There are no rules that cannot change. In fact, every time you feed it data, the rules changes. And therefore, it is much more adaptable in an environment, and it's actually easier to create a machine learning system because you don't need to have an expert sitting there and program line by line what you should do under what circumstance. So I would say that expert system is what most of the quantitative trading system are designed, are based on. And actually, they're mostly successful, interestingly, unlike playing chess. So here is a very different from playing chess, right? In finance, most of the expert systems work whereas most of the machine learning system doesn't work. It's very hard for the machine to learn all the rules of how to trade by itself. In contrast, in playing chess, it's the opposite situation. It is very hard to handcraft rules that can beat the grandmaster in chess, but the machine learning system that, for example, DeepMind built have handily beaten chess grandmaster, Go chess master, whatever game that you propose, they have beaten. They are now the best game player against any game whatsoever that you can think of. So you can see that's actually quite different situation in finance versus non-financial domain.
Okay, so I just checked your website. I realized somewhere you mentioned upload your historical data, right? So that's historical data means is that for a specific stock or bunch of stock, or that's also, the historical data for some traders, whether they were successful before or they were, maybe they lost a lot of money or they gained a lot of money. So what kind of historical data you talk about, for your model?
The latter. So we don't need you to tell us what the historical return of stock. We have that data ourselves. There's no point to upload that because again, we are not going to predict whether Apple is going to go up tomorrow. If we can predict whether Apple is going up tomorrow, why should I sell that system to you? Why don't I just trade myself, right? That's the usual argument. What I get out of charging you a few bucks when I can start a hedge fund and make billions betting on Apple. So the whole idea is that we offer this system only to predict your own strategies, whether it's going to be profitable or not. And we cannot profit from that ourselves because we don't know what the trading strategy is. We only know the historical returns of the strategy day by day.
Oh, so that's individuals record for their trading record, that's not right. The stock. Okay, I see.
That is right. Yes.
Mm-hmm. So does that mean if everybody lost all the money all the times, if he put the data there, he will lose again?
If people have a track record and lose money all the time, our machine learning system will tell you stop trading, give up.
Okay, so
yeah. Actually, that would be an easy case. Yes. Or just, obviously, if you lose money all the time, you should just make the opposite trade yourself. Then you would make money all the time. So you don't need machine learning either in that case. The only difficult case is you are 50% of times or 51% of the time you make money, 49% of the time you lose money. So yes, you make a little bit of money, but the risk is too big. So you want to increase the consistency, lower the risk and increase the consistency of your trading. That's when you need to use our system.
Okay, great. Thank you.
You're welcome.
Hi, Dr. Chen. I would like to say what do you think about the Bitcoin? And based on your experience, is the Bitcoin a good investment?
Well, I don't know whether Bitcoin is a good investment, but Bitcoin is just another instrument for trading. We using our technology, we have created actually a Bitcoin trading strategy. We started trading in beginning of June. Year to date, it returned more than 19%. So it works whether Bitcoin go up, Bitcoin go down, or Bitcoin go sideways. So to us, we don't make any judgment of whether Bitcoin is going to go up or down, but we only trade it as a trading instrument, and it was actually fairly easy to use machine learning to trade Bitcoin because it's a less efficient market than the more developed market. So we love Bitcoin because it offers this opportunity to demonstrate that machine learning can work very well in that market.
All right, thank you.
Yeah, Dr. Chen, it's interesting. You mentioned the term called efficient market, right, in the stock market. Right? Yes. In the Bitcoin, it's a less efficient market. Is that the underlying assumptions that the normal AI strategy may not fit in the efficient market that almost every party get all the information they need to trade? So that's why machine is so hard to take advantage of it. But in the less efficient market, that some strategy, if they're smart enough, they can take advantage of it.
That is true. Yeah, I agree with that. That's applied to both expert system as well as machine learning system. So for the Bitcoin strategy, we started with an expert system and we apply machine learning to it. but both of them work very well. And but for traditional market, the machine learning, if you apply it directly to traditional market, it won't work very well. And even expert system work less well because if it's not easy for the traditional market because of the low signal to noise ratio.
Yeah, thank you so much. I probably want to study finance just after you share your experience, right? Even though I'm majoring in computer science, I think finance is my next interest. Yeah. So,
Great.
yeah, very good. Thank you.
Thank you.
Dr. Chen, I got a question. So does your AI strategy also apply to high frequency trading?
Yes, it can be applied to, there are many papers on applying machine learning to high frequency trading, and so that, but not to ultra high frequency, because you have to remember that nowadays when people talk about high frequency trading, they're talking about sub-millisecond latency. Well, if you have a complicated AI system, it takes some time to do the computation. It's going to take more than 1 millisecond to make a decision. So it cannot be applied to ultra high frequency trading. But if you're talking about maybe a trading frequency of 1 second, that is certainly applicable, but not to like a millisecond level trading.
Thank you.
Well.
Yeah, very good. Any more question? I think we have only one more question. I know Dr. Chen's time already 10 in Toronto, not Toronto, Naga-on-Lake, right? Naga-on-Lake.
That's right.
Oh, by the way, Coach Bill is also living in Canada. He's in Toronto.
Oh, wonderful.
Any more questions from coaches, students? Yeah, by the way, Dr. Chen, we have different people here. Dennis, Dr. Dennis, he's he worked for Amazon, and Professor Chen just asked you a question. He's the actual professor for bio in University of Texas. So we have different people, different coaches. We're all volunteer. Yeah. Great. Thank you for the talk. I really appreciate it. Yeah.
Oh, thank you. Thank you for inviting me. Have a good evening.
Any more question? Last one? No? Okay. Thank you so much, everyone. Thank you, Dr. Chen. I appreciate your time, and we'll see you sometime. Yeah. Thank you.
Bye-bye.
Thank you. Thank you very much.
Thank you so much. Yeah.
Thank you.
Thank you.
Bye.
Bye.
Bye-bye.